the slowdown in housing is perhaps often misinterpreted as being generated by the higher interest rates. In fact, there's a much more demographic element to it, related to the fact that most of the millennials and the people who are in the 35-year age bracket, they can't afford a house. And it's not because of the interest rates, it's because of the down payments.
Yeah. D.R. Horton would probably take issue with that, but it's a demographic play, mobility play.
Exactly. These are relevant factors. I'm not saying interest rates don't matter at all. They certainly do. But at the margin, some of these other factors are weighing on housing relatively more than they would have at an earlier time.
All right. Then what about CapEx? What about overall financial conditions, things like that?
Well, if you look at interest rates, they're a little bit on the rise, but overall financial conditions are still very accommodative. So we have to take a broader perspective than just interest rates.
So you are clearly not in the camp, Catherine, that says the Fed's missing out on some pockets of weakness and they should slow down a little on these rate hikes.
Well, there are some issues with regard to balancing the objectives of returning asset prices, the constellation of asset prices that we have right now. There's a lot of risk in the system that hasn't really been priced yet. There are some prospects for inflation surprises that have not been priced in yet. And so in some sense, the Fed has to keep their eye on that as well as on the economy. I mean, we have a tremendously robust momentum in the consumer sector, and that's going to power the economy forward.
You know, a lot of people sort of point to October's weakness in stocks, and the day when Powell said long way from neutral with Judy Woodruff. He's going to speak in Dallas, I think, next week. Any chance he tries to refine that line, what he said?
Well, first he did say that we should be careful about what we mean when we say neutral. Right? There's a neutral for the real economy. There's a neutral for financial markets. And actually right now, the robustness in the real economy, robust consumption, I think there's actually fairly robust investment. That needs to be balanced against the realignment of asset prices that has to happen as part of the normalization of monetary policy.
So what I'm trying to figure out, Catherine, is the bigger risk right now that the U.S. economy is running too hot, overheating, or actually slowing down because of what's happening globally and tariffs and all of that?
So I think we have to make the distinction between what's happening in the domestic economy and firms that are basically domestically oriented, don't really pay attention to the global economy. They don't really pay attention to Wall Street. Sorry about that. And the other set of firms that are very globally engaged and are very involved in Wall Street. There really is a distinction between those two parts of the U.S. economy. I think we saw that playing out in the elections as well. And so the Fed has to manage this combination of what's happening in the economy, domestically oriented, not financially engaged, versus financially engaged and externally oriented, and balance those two.
So what does that mean? One hike in December and how many next year?
Well, we are looking at one hike in December and two more next year.
And you think the market can handle that?
Well, the market hasn't yet gotten on the same page with the Fed for next year. We're still missing about 50 basis points between what the market thinks and what the Fed says that they're going to do. So closing that gap is going to have big implications for where we are next year.
And so you mentioned the election. Did anything on Tuesday change your view of the economy through trade policy, debt limits, things like that?
Well, I mean, the trade policy is very much at the executive level, and the trade hawks and the national security hawks are in a strong alliance there, so I don't see any changes in the direction for trade policy. Now, the debt ceiling and the fiscal cliff become important ingredients for the profile for the U.S. economy going into 19 and beyond. So those really should be the objectives of the Fed watchers and economy watchers.
Does that get interesting on December 7th, or does that maybe get pushed into March or later?
It'll get pushed into March or later, yeah. But it should be on the minds of those who are taking long-term investments, because the decisions on those two aspects, the trouble around the debt ceiling, there's always a little bit of a turbulence about that, but more importantly, the prospects for a bipartisan agreement to push the fiscal cliff off to the future changes the trajectory of the U.S. economy dramatically between 19 and 20. And if you're a capital investor, or you're looking at CapEx or financial investments, and you're looking beyond the short term, you need to be thinking carefully about those two trajectories for the U.S. economy.
So the upshot for growth, the administration says it wants 3% at least annual growth. Looks like it's going to get that this year, right?
So.
What about next year?
We're pretty close to that for next year. We see a lot of the gains from both the fiscal spending that was part of the 2018 bill is going to show up in 2019, and there will still be strength from the 2017 tax cut, observed in 2019 as well. So we've got both parts of the fiscal cylinder going. As I say, domestic demand is very strong. Consumers are out there. Unemployment's fallen. We're going to see a little bit more wage increase. That's pretty robust.
Yeah. Catherine, thanks.
Thank you very much.
Very helpful. Catherine Mann joining us from Citi.